Despite new actions by the EU and the ECB, the euro is down almost 3% this month. Well, our next guest stayed bullish on the euro for years, but he is now selling the currency, and he holds it at the lowest level he ever has. Joining us is Axel Merk. He's head of Merk Investments, managing almost $800 million in currency-focused funds. Axel, always good to have you here on Street Smart, particularly on a day like this. It's sort of astounding to me that we don't see the euro versus the dollar break down more. I've heard many explanations for it, but what is your take on it?
Well, we're just more positive on other currencies outside of the dollar space. If you think about it, in the Eurozone, we don't have a current account deficit. So even the stagnation, lackluster growth period doesn't mean the currency has to plunge. What's happening now is banks need to repair their balance sheet. And the ECB is putting an overdrive here into place. They're splitting the coupon, so to speak. When the Federal Reserve engaged in quantitative easing, they bought government bonds. Now, the ECB, they're only taking 1%, and they leave the rest of the coupon on the table, so the banks can go out and get serious profits by going out. Now, the only thing that's going to do, though, is it's going to prevent a massive deleveraging. And if you think about what happens when banks deleverage, they take the money back home. European banks are the largest funders in emerging markets, and also they invest a lot in the US as well. They're taking the money back home. So what we think is going to happen, the ECB is going to stabilize the banking system for the time being. At the same time, the central banks of the rest of the world will try to push against that. In that environment, the euro will be reasonably flat, but the commodity currencies should benefit the most from the reflationary efforts we're going to see yet again in the world, from the Fed, from the Bank of England, Bank of Japan, and so forth.
I want to get to those commodity-based currencies in a moment, but I want you to go back a little bit to sort of the notion of bringing assets back, and also the idea of the ECB sort of propping up the banking industry there. What's to say? I mean, the banks are under no pressure to go out and actually buy European sovereign debt. And the interesting thing about today's market moves is that when we actually look at sovereign debt, yields are rising pretty much across the board. We saw Italy's 2-year and 10-year much higher today. Same for Spain, same for Portugal. Does that, from your perspective, do you think that maybe the banks don't actually go out and employ that and go out and buy bonds?
They'll spend the money, but not on sovereign debt. There are a couple of reasons for that. One is, by regulation, banks take zero buffer against default of European sovereigns, and which means it's very difficult for them to buy sovereigns when there is a default risk. Secondly, the European Banking Authority forces them now to use market valuations, again, creating a greater need for capital buffer. If you take a capital buffer, then you can buy risky assets. But if you're told it's not risky, yet it is risky, you have a problem. Secondly, the banks do urgently need to improve their capital. They don't do that by piling up more sovereign debt. And so this is providing them the much-needed reprieve, so they don't have the funding desperation that they otherwise have. So that's all this is going to do. The European Central Bank has made it very clear they're supporting the banking system, but the sovereigns are on their own. And that's the sort of gameplay we'll continue to see. We need to have that as well. Otherwise, the sovereigns are not going to engage in the necessary reform, and Draghi is not going to ease up on that.
Axel, I mentioned right before we went to the commercial break, Tom Fitzpatrick, analyst at Citigroup, saying that he actually sees the euro going to sort of 110 by mid-next year. Is that something that you don't agree with? Do you think we stay at this 130 level?
I think it's unlikely. It's because currencies are not in a vacuum. Think about how the rest of the world is going to react if indeed some of the worst case scenarios play out in the Eurozone, and we don't ignore them entirely. But if that's going to happen, the central banks around the world are going to panic. The European Central Bank, though, has shown that the way they panic is by supporting the banks, not the sovereigns. A Federal Reserve, the 3 dissenters are not voting next year. Only one hawk left at the Federal Reserve. Bank of England making it very clear they're eager to print money. Bank of Japan just authorizing billions and billions on firepower to print more money. Even the Reserve Bank of Australia easing up. And so we will have a very accommodative monetary environment, and the European Central Bank is going to less of that. Now, of course, what we've seen today is quantitative easing, but don't expect that the European Central Bank is taking the lead. The rest of the world is going to jump into that fray. And in that environment, we don't see that the euro is going to be as weak as people expect, simply because in the US we're better printing money than the rest of the world is.
Let's turn to the commodity-based currencies. Which are your favorite?
Well, the New Zealand dollar, Australian dollar, maybe. In Canada, they're very reluctant to allow the loonie to appreciate versus the US dollar, so they're always a step behind. But in Australia, yes, they have lowered interest rates right now. But if we do engage in this reflationary trend, and remember, China is again trying to ease as well at tepid paces right now, but let this crisis worsen and things will step up. And as we throw money at this problem anywhere in the world, again, it's going to go where we have the greatest monetary sensitivity. Precious metals, commodity currencies are going to be the winner in that environment.
Axel, thanks so much for joining us. Always a pleasure to have you here on Street Smart. That was Axel Merk of Merk Investments.